Hi everyone, and welcome back to ACCA P4, the last session for the revision. Based on our lecture sequence, we are left with two questions to answer, which are Dorico and then Mercury training. So we're going to look at the Dorico, which is on capital reconstruction schemes, and then the Mercury training is on cost of capital. So we're going straight to Dorico, which is on capital reconstruction schemes. So it is a very, very big question, and I'm not going to tell you to use this one as a standard, but the reason why I'm solving this is it brings so many ideas. Okay, I'm not going to allow you to think that this is the type of question that you're going to have, because the exam focus have actually been changed. So this question is being solved because there are so many technical things that we can learn from it. So as usual, we're going to start from our requirement to know what we are expected of doing. So I'll go straight to the requirement, and is prepare a report for the board of directors evaluating the financial and non-financial impact of all the three proposals to Dorico's main stakeholder groups. That includes I, an estimate of the return the debt holders and shareholders will receive in the event that Dorico ceases trading and is closed down. 2, an estimate of the income position and the value of Dorico in the event that the restructuring proposal is selected. State any assumptions made. 8 marks. An estimate of the amount of additional finance needed and the value of Dorico if the management buyout proposal is selected. State any assumptions made. 8 marks. A discussion of the impact of each proposal on the existing shareholders, the unsecured bondholders, and the executive directors and managers involved in the management buyout. Suggests which proposal is likely to be selected. 12 marks. Professional marks is 4 marks because it's a report format question. Okay, what is the debrief of the requirement? Okay, this is a capital reconstruction scheme, or basically it's a reorganization scheme. And when a company is having financial difficulties, making so much losses, they need more money to turn the company round. But if you are making losses and you are in financial difficulties, where are you going to get the money to turn your company round? The only thing you can do is to restructure or reconstruct or restructure the capital of the company, and that brings about the capital restructuring or capital reconstruction schemes. Okay, how do we restructure? As I said, when a company is having financial difficulties, normal lenders like the bank manager, the stock exchange might not necessarily be prepared to give money to this our company, and as such, either the company is supposed to liquidate now, or the company is supposed to ask the existing shareholders and debt holders to bring in extra money. So they will be prepared to bring in extra money in order to turn the company round, provided when they bring in the money, the company will actually be turned around from being a loss-making or financial difficulty company to a profitable company. If they wouldn't be able to be assured that they will be able to turn the company around after providing the money, then it would have been better for the company to liquidate, so that everybody will have his or her peace of mind. So when there is a capital reconstruction scheme question, it follows stages. Your first stage is you would have to check the position of the capital providers, both equity and debt holders. What will be their position under liquidation? Under liquidation, the whole of the assets of the company are supposed to be sold. When we sell the asset, we would have to use the net proceed from the sale of the asset to pay off what? The company's liabilities. Paying the liabilities, some of the liabilities are secured, some of them are unsecured. So when you are paying the liability, there will be the need for you to check whether some of the debt or the liabilities are secured or not. If they are secured, you give the secured debt priority. You pay them first before you think of the unsecured one. Then when you finish, you pay the preference shareholders, and then you also pay the ordinary shareholders if some of the money is left. If the money is not enough to pay all of them, don't forget that the company is a limited liability, and the liability is limited to the amount of the asset. So if the asset net proceed was, let's say, 100,000 and the liabilities were 120,000, the maximum the company can pay will be the 100,000. It means some of the liability holders, they will lose their 20,000, and equity and preference shareholders, obviously, even the liabilities or the debt, we couldn't finish paying it. Equity and preference shareholders, you don't get anything out of it. So that is how the liquidation position will be. Then when you finish the liquidation position, you also have to go and check what will be their position after the restructuring. The restructuring will be successful if the existing shareholders, the debt holders, will be able to provide reasonable money, because we need money in order to turn the company around. Therefore, check the adequacy of a cash flow coming in, because we need to get money in order to buy new investment, in order to turn the company into profit. So will that restructuring bring enough cash flows? If it will bring enough cash flows, then the restructuring will be able to bring assets and investment for us to turn the company around. How do I check the adequacy of the cash flows? It's just an issue of receipt and payment. How much money will come in and how much money we will pay. All of them, the examiner is supposed to be giving to give those ones in the exam question. Then the next one is when you check the adequacy of the finance, check the financial position immediately after the reconstruction, which is technically sort of a balance sheet, and then check the income position, and then check the financial position of the company in terms of the value of the company. And the value of the company, we calculate the market price of the company share after the reconstruction, and that can be calculated either using PE ratio, dividend valuation, the free cash flow basis, dependent on the question. Any method of valuation the examiner can also ask you there. Then you also look at the reaction of each of them. The reaction of each of them is that for there to be a successful restructuring, then all the parties involved are supposed to be treated fairly. For instance, debt holders know that they would have to be paid first before equity holders in terms of liquidation. So if you are trying to restructure and you want them to bring money, and they expect that the monies that they are paying, they are actually contributing even more, and they are suffering more than the ordinary shareholders, they will say, why should we even think of the restructuring? Because when it is liquidation, we are supposed to be paid first. So they will go in and liquidate the company. So check the fairness of the whole restructuring business. Given this particular question, the examiner went further to bring management buyout. And management buyout occurs when the managers of a division or a subsidiary will buy that division or subsidiary from the owners. Okay, and the examiner also wants us to do something. Okay, this management buyout is what made the question a bit funny, but you do not have to be worried about that, because I want us to solve this so that we can bring our mind on certain basic things. So this is what the examiner has used. The whole flow of capital reconstruction scheme is what he has used to set the question. So question I is telling you when the company should cease trading. Okay, when the company should cease trading, meaning when the company should liquidate. What will be the return to debt holders and equity holders? Meaning, sell the company's asset, whatever proceed, use it to pay the liabilities and equity. How much liability holders will get, how much equity holders will get, and then come and do the restructuring. you need to look at the income position, the financial position, the cash position, and calculate the market value as the company is even telling you to do. And then the last one is the management buyout, which is not normally part of capital reconstruction questions, but the examiner decided to bring it here. So let's go to the question. We are going to read that big scenario, and then when we finish, we will indicate all the necessary information we needed to do this. If you look at this, it's only 35 marks. If it is currently, it would have been about 50 marker question. Okay, so as I said, don't use this big question to judge, but I want us to think about the whole aspect of business reorganization. That's why I picked this question. So now let's go and read. Okay, I start. Dorico, a listed company, has two manufacturing divisions, parts and fridges. It has been manufacturing parts for domestic refrigeration and air conditioning systems for a number of years, which it sells to producers of fridges and air conditioners worldwide. It also sells around 30% of the parts it manufactures to its fridge production division. It started producing and selling its own brand of fridges a few years ago. After limited initial success, competition in the fridge market became very tough, and revenue and profit have been declining. Without further investment, there are currently few growth prospects in either the parts or the freight divisions. Dorico borrowed heavily to finance the development and launch of its fridges and has now reached its maximum overdraft limit. The markets have taken a pessimistic view of the company, and its share price has declined to 50 cents per share from a high of $2.83 per share around 3 years ago. Extract from the most recent financial statement. Financial position as at 30th November 2010. Asset, non-current asset, land and buildings, machinery and equipment, current asset, inventory, receivables, total asset, equity and liabilities, share capital, reserves, non-current liabilities, 7% unsecured bonds, other unsecured loans, currently 5.13% interest, current liabilities, payables, bank overdraft, currently 10% interest, total liabilities and capital, income for the year ended 30th November 2010, sales revenue, parts division, freight division, costs prior to depreciation, interest payment and tax allowable, depreciation, finance cost, interest, tax, loss. A survey from the refrigeration and air conditioning part market has indicated that there is potential for Dorico to manufacture parts from mobile refrigeration unit used in cargo planes and containers. If this venture goes ahead, then the part division before tax profit are expected to grow by 5% per year. The proposed venture will need an initial one-off investment of $50 million. Suggested proposals. The board of directors has arranged for a meeting to discuss how to proceed and is considering each of the following proposals. 1. To cease trading and close down the company entirely, that is to liquidate. 2. To undertake corporate restructuring in order to reduce the level of debt and obtain the additional capital investment required to continue current operations. 3. To close the freight division and continue the part division through a leverage management buyout involving some executive directors and managers from the part division. The new company will then pursue its original part business as well as the development of the parts for mobile refrigeration business described above. All the current and long-term liabilities will be initially repaid using the proceeds from the sale of the freight division. The finance raised from the management buyout will pay for any remaining liabilities, the additional capital investment required to continue operations, and repurchase the shares at a premium of 20%. The following information has been provided for each proposal. Ceasing trading. Estimated realizable values of assets not sold as a going concern are land and buildings, machinery and equipment, inventory, receivables, corporate restructuring. The existing ordinary shares will be cancelled and ordinary shareholders will be issued with 40 million new $1 ordinary shares in exchange for a cash payment at par. The existing unsecured bonds will be cancelled and replaced with 270 million of $1 ordinary shares. The bond holders will contribute 90 million in cash. All the shares will be listed and traded. The bank overdraft will be converted into a secure 10-year loan with a fixed annual interest rate of 7%. The other unsecured loans will be repaid. In addition to this, the directors of the restructured company will get 4 million $1 share options for an exercise price of 110, which will expire in 4 years. An additional one-off capital investment of 80 million in machinery and equipment is necessary to increase sales revenue for both divisions by 7% with no change to the cost. After the one-off 7% growth, sales will continue at the new level for the foreseeable future. It is expected that the Doric cost of capital rate will reduce by 550 basis points following the restructuring from the current rate. Management buyout. The parts division is half the size of the freight division in terms of the assets and liabilities attributable to it. If the management buyout proposal is chosen, a pro rata additional capital investment will be made to machinery and equipment on a one-off basis to increase sales revenue of the part division by 7%. Sales revenue will then continue at the new level for the foreseeable future. All liability categories have equal claim for repayment against the company's asset. It is expected that Doris cost of capital rate will decrease by 100 basis points following the management buyout from the current rate. The following additional information has been provided. Redundancy and other costs will be approximately 54 million if the whole company is closed, and pro rata for individual divisions that are closed. These costs have priority for payment before any other liabilities in case of closure. The taxation effect relating to this may be ignored. Okay, corporation tax on profit is 20% and losses cannot be carried forward for tax purposes. Assume that tax is payable in the year incurred. All the non-current assets, including land and buildings, are eligible for tax allowable depreciation of 15% annually on the book values. The annual reinvestment needed to keep operations at their current levels is roughly equivalent to the tax allowable depreciation. The 50 million investment in the mobile refrigeration business is not eligible for any tax allowable depreciation. Doris' current cost of capital is 12%. We have to write a report. So all the calculations obviously are supposed to be in the appendix, and we've already known how to prepare a report, so I'm just going straight. So the first one is an estimate of the return the debt holders and shareholders will receive in the event that Dorico ceases trading and is closed down. So when Dorico ceases trading, we have to sell all the asset and whatever proceed we will get from the sale of the asset, we would have to use it to pay the liabilities, and then including the redundancy payment, and whatever is left is supposed to be given to the equity holders, isn't it? Okay, so if that is the case, look at this question, extremely big. How many pages? 3 pages. How will you be able to answer this? You can only answer this question if you be able to coordinate the information well. It's the coordination of the information that actually motivated me to bring this. So even though I'm solving capital reconstruction scheme question, I'm also trying to help in a situation where you go and get a question which is information overload, how you have to coordinate them. I told you you have to be indicating as we normally do, but as we come here, I need to seize the company, so I need to go straight to information relating to the seizing of the company. If the company is supposed to liquidate, my principle tells me straightforward, I will need to sell the assets of the company, and whatever net proceed I will get, I have to use it to pay off its liabilities. So I come to the question, asking the question, you are big though, but what I need now is, what are the net sales proceeds from the sale of the asset you have? So I go to their current balance sheet or statement of financial position. These are the assets they have. They have land and building, machinery and equipment, inventory and receivables. All these assets are supposed to be sold. Obviously, if there is cash, you can't sell cash. So that is the monies you get already. So you will pick it. So I go to the note. These assets here, if I should sell them, how much should I get? Any asset here, if I go to the note and they haven't given me its sales net proceeds, or what I'm going to assume is the sales proceed is the same as the balance sheet figure. So any asset here that its sales proceed or net sales proceed is not given, we interpreted that it is in relation to the book value. You pick it as it is, that it will be sold at the book value. So I'm going to start, okay, land and building, machinery, inventory and receivables. These are the assets they have. If I come down here, they said when they seize, the asset will be sold for these figures, isn't it? Therefore, the land and building will be sold for 60, machinery and equipment will be 40, inventory will be 90, receivables will be 20. The question in the exam room is, should I copy all these? The answer is obviously no. I need the total sales proceed net from the sale of the asset. I can see them straightforward. So I can pick my calculator. Okay. Now let's go here. 1, I will say when the company liquidate. Okay. What will happen? All the assets are supposed to be sold. Once I see all the asset figure there is no need for me to copy all of them again. If you go to the question requirement, how many marks is there? It's only 3 marks. So copying them is just wasting your time. Examiner has given the figures for you. And as such, he is not going to give you a mark for copying land and building, plant and machinery. No, just add them together and you will go away. So I will say net sales proceeds from sale of assets. I'm going to add all the figures together. So I come here straight. I have got 60 plus 40 plus 90 plus 20. That is going to give me a 210. So when I get this 210 as the proceed from the sale of the asset, what next do I need? I will need to pay off the liabilities. But we have to think of the ranking. And is there any redundancy payment? If there is redundancy payment, also check where is the ranking. are you supposed to pay it before payment of liabilities? How you will pay is strictly according to the information in the question. So let's go and ask the question. There are liabilities, there is redundancy payment. How do you want me to pay? Which one has got a priority? I need to ask the question. Question will give me the answer. When you come here, question said all liability categories have equal claim for repayment against the company's asset. And then when you come to the redundancy payment of 54 million, it said these costs have priority for payment before any other liability in the case of what? Closure. So that 54 million redundancy payment is having a priority over liabilities. So that 210 I got from the sale of the asset, I have to make redundancy payment first. So my redundancy fee or payment is given as 54. So when I pay the 54 out, how much will be left for payment of liabilities? 156. The liabilities, which one is having a priority? Question said all the liabilities are having the same priority. So I will come here and say, what is the total liabilities? What will be the total liabilities? All of them have got the same priority. So when I go to the question, I go to the balance sheet straight. I need all the liabilities because all of them are having the same word, preference or priority. So I have got liability of 7% unsecured bond, 120, other unsecured loans, 30, payables, 70, and overdraft of 60. I am going to add all of them. I'm not writing them 1-1. So 120 plus the 30 plus the 70 plus the 60 is giving a total of a 280, isn't it? It's giving a total of 280. So I will say 280. What has come up? I need to pay liability of 280, but the monies I have available is 156. It means I can't pay all the liabilities. Company is a limited liability, meaning their liability is limited to the value of the asset. The value of the asset left is 156, and what we have to pay is what? 280. We can't pay all. So it means we can pay the liability of 156 out of the 280. So how much is the percentage? 156 divided by 280 is giving me about 56%. So it means the liabilities we can pay 56%, and as such 44% cannot be paid. So we're going to tell the examiner here that the debt holders, the return they will get, should we decide to what? Liquidate the company, is they will get 56% of their value, and as such they will lose the 44. So debt holders will receive only 56% of the capital. What about equity holders? Equity holders, even debt holders, we are not able to finish paying you. So how much equity holders? Equity holders will receive nothing. So equity holders will receive absolutely nothing. Even debt holders, we were not able to pay. So when the company should liquidate, this will be the movement. When the company should liquidate, then this should be the movement. Now, if we go to the question is also telling us requirement 2 is saying an estimate of the income position and the value of Dorico in the event that the restructuring proposal is selected. State any assumptions that you make. Okay, so now let's see the restructuring. What is the restructuring? Restructuring is we changing the right of our existing capital providers. Maybe you are equity holder. We can cancel your equity and tell you to bring in more money. Maybe you are debt holder. We are not paying you interest. We are owing you interest. We can waive all the interest, cancel it, and tell you to bring more money. It is your choice. If you bring the money, we can use that money to turn the company round. If you don't want to bring the money, directors wouldn't have any choice than to liquidate the company. And when we liquidate the company, we have come to the realization that you, the debt holder, you get only what? 56, and in effect, you will lose the 44% of your capital. So it's your choice. So when there's reconstruction, I normally tell students, it is all issue of following instructions in the question. That is the reason why reconstruction questions are extremely big. Okay, so now let's go to II, which is in relation to the restructure. When you come to the restructuring, your first level is, it follows stages anyway. Your first level is to check sufficiency of cash. Okay, so get your cash flow. To get your cash flow, you need to get your inflows, and then you have to get your outflows. Okay, it's like you doing a cash budget. Get your cash inflows and get your cash outflows. How will you get that? You would have to go back to the question and ask the question, if I have to restructure, what will be the cash I have to pay? And what will be the cash that I would have to receive? We need to read the question to come out with that information. So now let's go straight to the question. When I go to the question, where do I see restructuring? This is where the restructuring information is. So we're going to read, and whatever movement in cash, we put it in the cash flow. So I start reading corporate restructuring. The existing ordinary shares will be cancelled. What is the meaning? It means whatever ordinary shares we have there is cancelled. It's not going to be part of the new company. And ordinary shareholders will be issued with 40 million new $1 ordinary shares in exchange for a cash payment at par. What is the meaning of this sentence? The original ordinary shares, we are not paying anything. We have cancelled it. So say the question here. We have cancelled it. So no movement of money. And the existing ordinary shareholders, we are now going to issue 40 million shares with a nominal value of $1 for them to pay extra money. And what are they paying? They're going to pay it at par. And the par value is 1. So it's like we are issuing new shares to them at an issue price of $1 for 40 million shares. So they would have to give us money. And how much money they're supposed to give to us? 40 million multiplied by 1. And this one involves movement of cash. So I will say issue of shares to existing shareholders. We're going to have 40 multiplied by $1, which is $40. Okay, you read, you extract the cash flow movement. That's it. When you finish, you sum them together. It's like you doing your cash budget or cash forecast. You go straight to the question again. You continue. The existing unsecured bonds will be cancelled. It means we are not paying whatever it used to be there. We don't care. We cancel it and replaced with 720 million of $1 ordinary shares. The bondholders will contribute 90 million in cash. So we cancel whatever they had before and we are giving them shares of $1 each with 270 million. How much are they supposed to pay? They are paying 90 million. So money from debt holders. So unsecured debt holders, we gave them shares, and what they paid was, is it 90 million? what they paid is 90 million. You read, you post. Let's go and continue. The next one here is, we will say all the shares will be listed and traded, fair be it. The bank overdraft will be converted into a secured 10-year loan with a fixed annual interest rate of 7%. We are converting the bank overdraft to a secured 10-year loan. It has got nothing to do with movement of cash. And as a result of that, it doesn't affect our cash flow statement. So that is something to be dealt with in a different time. Then we continue. The other unsecured loans will be repaid. So if we have to pay the other unsecured loan, we have to pay using cash. So the other unsecured loan, how much are you that we are supposed to pay? I come back to the balance sheet. The other unsecured loan amount is 30. So that 30 is supposed to be paid. So it is a cash outflow. So I will say the other unsecured loan, and that is 30. I put it there. You read, we are coming out with the cash inflows and outflows. That's it. Okay, we go back to the question under restructuring, and it's telling us again, in addition to this, the directors of the restructured company will get $4 million $1 share options for an exercise price of 110, which will expire in 4 years. This has got nothing to do with cash flows. It's an option that they have the right to exercise it in 4 years' time. Currently, it has got nothing to do with what? Movement of cash, and I'm dealing with cash flows. So I leave it. I go on. An additional one-off capital expenditure of 80 million in machinery and equipment is necessary to increase sales revenue for both divisions by 7%, with no change to the cost. After the one-off 7% growth, sales will continue at the new level for the foreseeable future. Okay, so we have to buy machinery and equipment necessary to increase sales. So currently, we have to go and buy 80 million machinery and equipment. Money is supposed to go out. So we come here and we say purchase of equipment, purchase of machinery and equipment. They said it's 80,000. We move on. Okay, and then it is expected that Doris' cost of capital rate will reduce by 550 basis points. It has got nothing to do with cash flows. So based on the restructuring information, I have been able to extract the receipt and payment. If that is the case, let's go and sum them together. So my total receipt is going to be 130 here, and my total payment is going to be 110. Therefore, what is my net receipt and payment? What is the net receipt and payment? 1 minute. So what is the net receipt or payment? If it is payment, I'm putting it in bracket. So receipt is more than payment of 20. Then you ask, is there any cash balance at the beginning? Do we have any cash in the balance sheet? When we did it, there wasn't any cash in the balance sheet. Okay, if there was cash in the balance sheet, you would have said it's a balance word brought forward. There is no cash under the current asset. It means they haven't got any cash. They've got overdraft that we are converting, so that is not an issue. So if they were happen to be a cash, you would have brought balance brought forward, and as such, at the end, after the reconstruction, our balance carried down will be same as the 20. So it means there is sufficient cash that could be raised from the restructuring. After the restructuring will help us to raise additional money of 130 million from our existing shareholders and the unsecured bond or debt holders. And that money, we can use it to buy equipment. And that equipment will help us to increase our revenue in order to turn the company from a loss making to be a profit making. So the restructuring will be able to bring enough money to cover for the expenses we need to turn the company around. So that is enough. Whilst you have finished your cash flow, you also have to do your statement of financial position, which is the balance sheet. I normally say the reconstruction, you normally need a bit of accounting to do it. Okay, so what will be the statement of financial position post restructuring, immediately after restructuring? Post restructuring, okay, so we have to know what will be the assets and liabilities. You pick the balance sheet. Now we haven't sold any of them, we are restructuring, so our assets are there, and then we make adjustment to it on the basis of, did we sell some, did we purchase some? You are just doing sort of an incomplete record. So when I go there, I see land and building from my own the old balance sheet given to me. The land and building in the balance sheet given. Okay, let me push you back here. The land and building, I've come here. I'm bringing this asset. The land and building is given as what? Is it a 70? So I am going to bring the land and building is 70. I've also got machinery and equipment. The machinery and equipment in the current balance sheet, I've seen a 50. If you remember, I have seen a 50. So this is the 50. And what has also happened? What has also happened is that we have bought an additional equipment. If you remember, we bought an additional equipment of 80,000 that will increase sales revenue. So our equipment will now be increased by that 80. So I'll bring the 80 there, and this will give me 130. You are picking the balance sheet as it is, and you are making adjustment to it. So I was having machinery and equipment of 50. Nothing was sold, but we bought 80. So after that, I should have 130. I come to my inventory. Inventory. How much will be the inventory? Okay, so let's go straight. The inventory given in the question is 180. We haven't bought any more inventory. We haven't sold any inventory so far as the restructuring is concerned. So I will go and put it there. So I'll say this is the non-current asset. This is the current asset. I will say my inventory, which is going to be the 180. I also have receivables there. And the receivables I have, nothing has changed about it. So that 40 should also be there. So I'll come and say the 40. Okay. Then do I have cash? Yes. Because when we did our cash flow statement here, that is the reason why I advise students to start from here, because you need it for the purpose of the statement of financial position. So we said our cash balance at the end of the period is going to be 20. So I will say this is 20. When I sum it up, it should give me the current asset total, and that is total of 240. Okay, when I sum up this, it gives is it 200 here, and then this will give 240. So if it is 240 added to the 200 should give me 440. This is my total asset. Now I will need my total equity and liabilities. What will be my equity? Now the equity that we have in the existing balance sheet is cancelled out, and that will include whatever losses we were having. Loss, profit is a concept. It is not happening there. It's not there. So once we have cancels, like we are liquidating the old company and bringing the new company. Okay, so the equity, what happened based on the restructuring, Okay, based on the restructuring, we said the existing equity will be cancelled, but we're going to give them 40 million shares. And the debt holders too, we're going to give them 270 million shares with a nominal value of what? $1. So technically, the amount we have actually issued will be 40 plus 270 all multiplied by 1. So I will say my share capital will be equals to the 40 plus the 270 all multiplied by $1, and that is going to be, is it $310? The loss in the balance sheet, you do not have to bother yourself with it. It is also cancelled. The reserves is also what? Cancelled, because it's not happening. It's not something which is there. It's a concept. So it's gone. Then I will have to think about my non-current liabilities. What will be the non-current liabilities? The non-current liabilities, according to the question, if you go to the balance sheet given, it's all about coordination of information. The non-current liabilities, the 7% unsecured bonds is what was converted into equity. So it's no more there. The other unsecured loans, if you remember, was paid. So that one too is no more there. The payables will stay because the question didn't tell us it's paid. It will stay as current liability. And then the bank overdraft, what happened to it? If you remember, the question told us that the bank overdraft is now converted. Let's come back. The bank overdraft will be converted into a secured 10-year loan with a fixed annual interest rate of 7%. So if the bank overdraft is converted from short term, which is current liability, into 10 years, secure 10-year loan, then that qualify it to be a non-current liability. So now that bank loan is not a bank loan, it's what? 7% secured 10-year debt. And what is the amount of the overdraft? The amount of the overdraft that we are converting it at what? The 60 as it was. So we come and put the 60 in here. And then we also have current liabilities. We have the payables only. And how much is the payables? Go to the balance sheet. The payables is 70. Okay. And this is 70. When you add this, your balance sheet should balance. So you need to do a bit of accounting here. Otherwise, capital reconstruction is not going to be lovely. You need a bit of basic accounting. So this is what the position will be after the reconstruction. This is the statement of financial position. The next question we have to ask ourselves is, if we are able to get these monies, buy new asset, are we able to turn the company around by making the company more profitable? Okay, so let's prepare the income statement after the reconstruction, 1 year after the reconstruction. So now let's go and prepare the income statement. Okay, some of the questions, the examiner will be specific. Calculate the cash flow, balance sheet, and then income position. Here, the question specifically stated that we have to show the income position. Okay, look, income position of the company and the market value as a result of the restructuring. Okay, so the income position they needed is what we're going to do. Technically, this question they ask for the balance sheet and then the cash flows. But to do that, to get the income position, you need to get the flow in the balance sheet and the cash flow. That's why I did it. If somebody can use the eye to look at the workings, do the workings, that will also be brilliant. So now let's go to the income position. Income position, we are going to pick the current income statement and make adjustment accordingly. So sales revenue, cost, tax allowable depreciation, finance cost, tax, and then we calculate the profit. and we'll see whether the company will be turned into profit. So when we restructure, what will be the movement in the income statement? Everything should be in the question. The examiner has to give you that information. So come to restructuring and see the movement in there. Come to restructuring and see the movement in there. Under the restructuring, question said an additional one-off capital investment of 80 million in machinery and equipment is necessary to increase sales revenue for both divisions by 7% with no change to costs. With no change to the cost. Okay, so the revenue will increase by 7%, by cost is not going to increase. Therefore, revenue, how much are you now? The revenue given to us in the income statement now are these two figures here. Okay, revenue for the part division and for the freight division. Am I also supposed to show part and the freight? I wouldn't have time to do that one in the exam room. So I know the revenue is 170 plus what? 340. 170 plus 340 is 510. So when I come here, I will say this is the income statement just after 1 year. Okay, and what is going to happen is we have the revenue, and for the two divisions their total revenue now is 510 subject to 7% growth. So I will multiply 510 by 1.07, and that is actually giving 545.7. 545.7. I will also have to less what? Cost, because the question said cost prior to depreciation, interest, and tax. The total cost here are these two figures, 120 plus 370, and that is 490. But the question specifically told us that when revenue increased by 7%, cost is not going to change. Therefore, I will pick the 490. If I pick the 490, I will keep it as it is. So I will say 490.0. That is minus. We are following the income statement and we are making adjustment accordingly. So when I take those two figures out, I will need to less my tax allowable depreciation. So that tax allowable depreciation is not going to be this 18 that we have there. It's going to be based on the company's new asset. So what is the company's new asset? If we go to the balance sheet we prepared, we will be able to know the company's new asset. So the depreciation or capital allowance is based on non-current asset. So when I come here, this is the non-current asset total value of 200. How do you want me to depreciate or capital allowance it? So I will go to the question and go and ask. Look at where the examiner put information about capital allowance. It said here in this paragraph that all the non-current assets, including land and buildings, are eligible for tax allowable depreciation of 15% annually on the book values. Question said all the non-current assets, including land and buildings, even though we know land and building is not subject to depreciation, but this is tax allowable depreciation. So says the question. Let's go ahead with it. So 15% annually, book based on the book value. What is the book value of all the non-current asset? The book value of all the non-current asset is the 200. So my depreciation will be, my tax allowable depreciation will be the 200 multiplied by 15%. and how much will it be? So 200 times 0.15 is simply what? 30. And that is the depreciation. So when I deduct the 30 out of this, this one will give us our operating profit. Or somebody will say, without exceptional items, profit before interest and what? Tax. Okay, and how much is that? 545.7 minus 490 minus 30, and that is given 25.7. Then I would have to get my interest. I need to ask myself, how much will be the total interest I have to pay? Interest I have to pay is not the same as interest before, because interest I have to pay should be based on the amount of debt I have. Don't forget, as a result of the restructuring, some of the debt went to shares, some of the debt were paid. So I go to my new balance sheet. When I come to my new balance sheet, the only debt I have is this 7% secure debt of what? 60 million. So how much interest am I supposed to pay? How much interest am I supposed to pay? Let me confirm the rate. The overdraft is 7% interest. So how much am I supposed to pay? I will pay 7% multiplied by the 60. So 0.07 times 60 is giving me 4.2. And that deducted will give the profit before what? Tax. So from 25.7, and that is given 21.5. And what is the tax? What is the tax rate? We go to the question, can you give me tax rate? Tax information is given on the third page, and it's saying corporation tax rate is 20%. We cannot carry forward losses. So I will say 20% of the 21.5. So times 0.2 is giving 4.3. And when I sum them up, it will give me profit after tax. We have been able to convert a loss making to what? A profit making company. And how much is it? The figure is 17.2. So this is the income position the examiner was actually asking for. And as I said, the question specifically didn't ask for the statement of the cash flow and the statement of financial position. But to get the income position, I will need this 200. So if you know what you're doing, you can avoid doing all that straightforward. You will be able to get the 200. And you also have to remember that you also need this 67% for the purpose of what? The interest. That is the reason why I did that. If you can use your eye to do the movement by way of workings, the question didn't request for it, but I have done it for you to understand it. And secondly, if the question in another setting asks you to prepare those ones too, then exactly you know what you're supposed to be doing. Okay, we haven't finished that question. That requirement, that question requirement is saying get your income position. We have got it. And the value of Dorico in the event that the restructuring proposal is selected. So we have got the income position. We also need the value of what? Dorico. How will we get the value of Dorico? It calls for valuation of business. How will I calculate the value of this company? What valuation technique should I use? I have got the income statement, and giving me income statement, giving me cost of capital, I will be able to use the free cash flow method to calculate the value of the company. Because according to the free cash flow method, the value of the company called the corporate value is the present value of the future free cash flow discounted using WACC. And look at what the examiner did here. Examiner told us that under reconstruction, Doris' cost of capital will fall or reduce by 550 basis points. So I can have the WACC, and giving me income statement, I should be able to calculate free cash flow. So I'm going to calculate the free cash flow out of the income statement and bring myself to the level where I will be able to calculate the value. So value of the company, value of company. We are using the free cash flow, and we said corporate value is equals to PV of the free cash flow discounted using what? WACC. So what will be the free cash flow? Free cash flow is equals to my operating profit or profit before interest and tax minus the tax. Add what? Non-cash items like depreciation, okay, less working capital, less fixed capital. This is how I get my free cash flow. I'm going to the question to bring this. 1 year's time, I have been able to calculate income statement. Prepare the income statement. I see that my operating profit, which is profit before interest and tax, is 25.7. So I will put it here, 25.7. What is the tax? You don't pick the tax there, as we said, because the free cash flow include the interest element. It's part of the money supposed to be given to debt holders. So the tax should be a percentage based on the operating profit. So 25.7 multiplied by what? 20% should give me the tax. Plus, I need my non-cash items like depreciation. Depreciation we calculated here is 30. Now be with me. Be with me. I'm going to bring something up, which most of you, if you joke, you wouldn't pick it. Okay. The question stated something here. Okay. Question stated something here that depreciation is 15% annually on book values. Continuation is the annual reinvestment needed to keep operations at their current levels is roughly equivalent to the tax allowable depreciation. This sentence has been stated in different P4 questions, and yet students are still not picking it. Don't read it like a storybook. I keep telling you, what is the meaning of this sentence? The annual reinvestment needed to keep operations at their current levels is roughly equal to the equivalent to the tax allowable depreciation. The money you need to invest day to day to maintain operations is what is defined as working capital. So that statement is telling you that your working capital is the same as depreciation. So if my working capital is equivalent to depreciation, then if I'm doing my free cash flows, be here. If I put my non-cash item of depreciation of 30, my working capital is also going to be 30 because they said they are equivalent. So when you see that sentence, then depreciation is the same as working capital increase, and aside these two will cancel out and it will be 0. So you don't even need to bring it at all. Okay, if you don't read that sentence, you would have brought, oh, there was depreciation of 30, so I will add the 30. Oh, there wasn't any working capital, and you will skip it. So anytime they tell you the money you need to finance operation day to day is equivalent to the depreciation, then it means they are the same. They will cancel out. Then I will also need my fixed capital. What is fixed capital? Fixed capital is the capital to buy equipment, isn't it? Like the non-current asset. Under the restructuring, question said we are going to buy additional investment in machinery and equipment of 80 million. Be with me. Even though it's a capital expenditure, I quite remember one of the mentoring session, a student asked that there was a question where there was a capital expenditure, but it wasn't included as part of the free cash flow calculation. This is one of the instances, okay? They said an additional one-off. This is what is making the whole change. Additional one-off capital investment of 80 million in machinery and equipment. So it is not 80 million every year. So you cannot bring it as part of the cash flows. We need the future free cash flows. And this 80 million is being incurred now, one off. It's not going to reoccur. Therefore, in the future, I haven't got any fixed capital to think about. Okay, so watch out for some of these small things. So what then will be our free cash flows? So we're going to say 25.7 minus minus the tax effect. So that times 0.8, and that is simply going to give me, is it 20.56? 25.7 times 0.8, 20.56. So this is my free cash flow. If this is my free cash flow, corporate value is the PV of the free cash flow at the WACC. So what then is the WACC? Okay, currently question is telling us that when we do the restructuring, the WACC will reduce by 550 basis point. 550 basis point is the same as 5.5%. So what is the current WACC? When we coordinate the information, this is where the current WACC is given. The current WACC is 12% and it's telling us that it should reduce by 5.5. So when we restructure, the WACC will be 12% minus 5.5%, and that I think is 6.5%. 12 minus 5.5, and that is 6.5%. So if it is 6.5%, this is our current WACC. Okay, now I need the PV of the future free cash flow discounted at WACC to infinity. So I have got a perpetuity. If I have got a perpetuity, a question should come up. The question is this cash flow subject to growth, or is it what? A constant perpetuity? I need to go and ask the question. Question said here that, okay, when we do the restructuring, they said after the one-off 7% growth, sales will continue at the new level for the foreseeable future. What is it telling us? What is telling us here is that when sales increase by 7%, it will not increase again. It will stay at that figure till the foreseeable future. So in the future, there's not going to be any growth. And as such, that perpetuity is a constant. Some people said because sales will increase by 7%, it means the cash flow should also increase by 7%. It was a good one, but this particular question, it doesn't fit in, because the question further stated that 7% too was also one-off. It's not something that is continuous. So I have confirmed that the sales is not going to grow, and as such there is no word growth. So if there's no growth, I have got a constant perpetuity. So my corporate value, constant perpetuity, is the constant cash flow divided by the WACC, and that constant cash flow we got is 20.56 divided by 0.065. And how much is the corporate value? 20.56 divided by 0.065, and that is given 316.31, and that is the value of that particular company. Okay, that is the value of that particular company. But don't forget that this value is what is called the corporate value.